CPI today came in lower than expected, down to 7.7% for the CPI, excluding food and energy, 6.3%. On that, the market started to rally. Dow is up 960 points. This is something that we haven't seen since stimulus checks. That's the least of them. The SPY's up 4.6%. The NASDAQ, the big one, up over 6% right now. Does this mean we are in an economic rally? We're going to go into extreme prosperity because everyone knows that the stock market is just predicting future earnings in the present, right? So companies are going to start to boom again. Well, why is the stock market rallying? People are saying CPI is coming in lower, therefore the Fed will be able to stop tightening sooner than later. That's going to be fantastic, right? Well, I mean, Fed funds right now is at what, 3.8%. They're still guaranteed to do another rate hike, and they said they do one more. So call it another 100, maybe 75 basis points. Where does that take Fed funds? It's 4.5%, call it on the low end. Justin, I mean, would you consider the amount of zombie companies that have extreme debt? There's no way they're going to be able to refinance at 4.5%. They're going to be just screwed. So before I go into what I did with my portfolio today, and I'll warn you, I did quite a bit. What are your thoughts on the CPI coming in lower than expected? And do you think the Fed will ease raising rates sooner than later?
So that I don't know. I think Powell seems to be very determined in order to crush inflation. And I suppose the market's making one of the explanations. Yeah, one of the explanations for this might be the market says, okay, well, listen, if inflation's getting crushed as per the CPI print, then Powell's not going to continue to raise rates or raise rates for as long as he might otherwise. Perhaps not. So there's that. The other thing, and this gets back into the world of the tech sector, since Twitter, or Elon taking over Twitter, fired a large part of the workforce, Microsoft, Meta, and probably others, but those are the three that come to my immediate recollection of announced pretty large layoffs, like 13% reductions in staff.
Right. Meta just released 10,000 employees.
And so the point from all of this is that if big tech was holding up the market and the FANGs were driving, or I should say it like this: if the FANGs were ultimately, propping up the market, and the FANGs themselves are running into economic headwinds, I certainly can get the fact that CPI going down would perhaps open the door sooner to the Fed easing off, or Powell easing off interest rates going up. Well, the market certainly seems to like the idea of getting back to lower interest rates. As far as Powell doing a pivot, I don't know. Maybe he won't be as aggressive going forward, but I don't think that
him slowing the rate of increases is not easing. And what is really going on with the bond market today? Because that's what is much more important than the stock market. Right now, the 3-month is down a little, but still remained elevated. But look at the 10-year, the spread between the inversion of the 10-year and 3-month is not looking any better. It is, you do not want to see the 3-month T-bill and the 10-year ever inverted, because there's almost we've never seen a time in history where we have not been in a recession when the 3-month and 10-year has inverted. And the inversion's only getting deeper right now. The entire yield curve is completely screwed, and it did nothing on news of the CPI coming down today. In fact, it just got even more chaotic. So what I did with my portfolio is I over the past few weeks, I ended up closing most of my shorts, but today I reopened a pretty big portion of them. I'm opening my position in tranches. Right now, I put about 1/3 of my total position size that I want to enter. And what would make me put the rest of that 60-60, the rest of that, let's say 2/3 back into shorting the market, what I would need to see is either the market goes up over the next few days, or we kind of just chop and economic news comes out that seems to be really bad, signifying that the economy is much worse than people think. Maybe the Fed gets more hawkish, and that would make me pull the trigger into putting the rest of my position size onto shorts. The way I'm playing it is mainly through NASDAQ puts, as well as there was a few companies today who doesn't matter what happens with the Fed, they should not be a company. Like a lot of these EV cars, one of them was up like 40% today. And I just thought that, all right, like I'll throw a few $1,000s into short in this thing, because through puts, because this company doesn't make money. In fact, it doesn't even make cars. It really just has a story that in times of economic uncertainty, I'm sure that it would come down. So the way I was playing all these puts, I was going out over, I think I was doing either the March or June contract for anything that I was buying puts wise. So that's pretty much what I'm doing. I want to increase my position size if possible, if we see 1 or 2 more up days, but I'm not sure if we will, because eventually the market's going to have to look around and see, well, what's happened with the economy? And it looks worse today than it did yesterday. And fundamentals will eventually override easy money.
Gotcha. So basically puts with plenty of theta.
Yeah, did you do anything today?
No, mainly because I just got up. So I'm still playing catch up here. I will probably take a look over the next few days and see what's going on here. But I probably have, like you, Josh, you and I are probably the same mind, where I have a much more bearish midterm outlook for the situation.
Yeah, how do you guys think it's going to play out? I was shocked by the reaction of the market, because the Fed has been extremely clear they're going to raise rates no matter what. And even if they stop raising rates right now, or they do 2 more rate hikes, the Fed funds is going to be at what, 4.5%. Where does that, what do companies look like? A lot of companies today look like at 4.5% interest rates for the next few years. A lot of these companies, there's no way that they would be able to support that kind of financing. So that's pretty much what I'm looking at, and waiting for something to happen. So thank you, and we'll see you in the next one.